Good evening, everyone. So we do continue to be in a very interesting trading environment with the focus on inflation and the actions of global monetary authorities. On a relative basis, we continue to see the Federal Reserve and the FOMC being more aggressive in raising rates than their central bank counterparts. And unsurprisingly, this has been a major positive for the dollar. And as we see here on the dollar index, the dollar's risen about 20% since the beginning of the year. So with last week's 75 basis point rate hike, we began seeing an acceleration to the upside for the dollar. And I wanted to take a look at one way in which you can capitalize on an anticipated move. And what does that process look like? So for this evening, I'm going to expand here and discuss how we can increase our potential return by using leverage and prudent risk management. Before we get into that, let's think about our basic binary trade. And that's how many retail traders express their risk taking. And all this means is that a position is initiated, and then at some future point, it's exited for the resulting gain or loss. So either you're in the market or out of it, hence it's binary by nature. But sometimes, especially in a market that's being driven by fundamentals, this can be a bit limiting. In our euro example here from earlier this month, we could have sold near 102 and potentially covered the trade near par for a nice gain. But what if the market subsequently continues lower? You no longer have the trade, so you can't participate in the continued trend. And psychologically, it's really hard to resell a market at a lower level than you just bought. And that's really, buyer's remorse, if you will. So what's an alternative? Well, instead of reducing a position or taking profit, we can consider adding to our position and increasing risk. And if our confidence in the outcome of a move is increasing, there's sound logic to this. Now we can generate returns at an increased rate if we're right. On the flip side, when we leverage a trade, we are, of course, increasing the level of risk. So if we're wrong, it can reduce the intrinsic value we already had in the trade. And this is quite different to our zero cost strategy, where we're reducing leverage in order to protect against any loss at all. But with the zero cost, we're also limiting our upside potential. Remember also, more risk can mean more margin. So keep an eye on that to ensure that there is no risk of a forced trade due to a margin call. So let's revisit our confidence indicator. What is my confidence level for a given scenario? And think about this too. Confidence is not static, and it changes with each scenario as price action plays out. So I can have high confidence for an anticipated short-term move, but little confidence beyond a short-term time frame. But that can change with time. News, central bank action, etc., could change my perception of longer-term price action, either increasing, confirming, or decreasing my confidence level. Critically, now you know your level of confidence, you can choose an appropriate level of capital to put at risk. And we keep coming back to this concept, but it really is the key to being able to trade successfully over time. So when I consider leveraging a trade idea, this is really a tool for those higher confidence levels over that more medium to longer term time frame. And we'll see that in a minute when we take a look at our euro price action post the FOMC rate hike last week. There are a couple of other things to think about. You want to keep an eye on overall price volatility, as this may affect liquidity and your ability to execute a trade at a given price. So your risk profile for yen or sterling could actually be markedly different to the euro dollar. So let's look at a successful break from September 21st. Heading into that FOMC week, I had a very bearish view on the euro based on expectations of a 75 basis point rate hike. And there was an outside risk of 100 basis points coming through. Technically, the euro had been performing poorly since Monday, September 12th, when it had actually turned aggressively lower from the 102 area. So bond prices also continued to trade lower, and they were making new trend lows on Tuesday, September 20th, and that was driving yields to new highs. So all in all, it's a very positive fundamental backdrop for the dollar. At the beginning of last week, however, the euro was finding some near-term support around this 99, 45, 55 area, and this looked to be fairly key for near-term technical support. So at this point, I have actually identified my initial sell area as a break of this 99.45 And so I would place an order to sell 50% of my risk capital just below this level at 99.35. At the time a position is initiated, I'd also want to place a stop to cover the position in the event I'm wrong. And here we can see near-term resistance at 100.50, which is the high of the week so far. So I can actually place a firm stop at 100.60 if the market reverses on the FOMC later in the day. As we move forward, the FOMC delivers on the 75 basis point rate hike as expected, and this sees a very quick sell-off to 98.12, followed by a pretty quick recovery to 99.10 over the next hour, before starting to drift lower again towards the end of the day, closing the day near 98.40. So now that that news is out, I'm shifting my focus to the post-FOMC support and resistance levels. The first thing I can do is bring my stop protection down to 99.20, which is just above that post-FOMC high. And there's really no reason to lose money on the trade at this juncture. If I get stopped out, I'll still have a small gain on the trade idea. So that's just prudent risk management. However, the fundamentals together with price action suggest that there may be further dollar strength in the short term. And how do I capitalize on that? And this is where adding leverage comes into play. When you have the potential for a short or medium term momentum-based trade, adding to an existing position can really help to capitalize on those moves. In this case, I want to add to the trade if we break under that 98.12 post-FOMC low. So I'll leave another order to sell another 50% of risk at 98 even. If this gets executed, my position averages is short 100% at 98.67. If I'm right about continued euro weakness, I'll accrue gains at twice the rate. But obviously, if I'm wrong and I'm subsequently stopped out at 99.20, I will actually end up losing money on the overall trade idea. So this isn't a trade scenario for everyone. You have to be comfortable with the increased risk level. And importantly, you need to have high conviction in the trade idea together with very clearly defined levels where you will exit the trade for an acceptable loss. If those conditions don't exist, then it's probably not a scenario you should consider adding leverage to. In this instance, though, the process worked extremely well. Euro traded through 98 even on Friday and continued lower all day. So at the end of the day, it's decision time again. Do I cover a portion of the position to reduce risk over the weekend? Do I trail my stop down to protect my gains so far? Or do I continue to let the dice roll and hold the full position, anticipating further euro weakness? And they're all valid choices and really will depend on your individual circumstance and personal risk comfort level. But it is super important to continually reassess your options. So that's adding leverage to a trade. It's a strategy I've used frequently over the years, and on balance has been an extremely useful tool. So if it fits in with your risk appetite, it's definitely worth taking a look at.